All right, let's get right into it. Today we're going to try and break down a DeFi yield product called Sensei Yield. Our goal here is to unpack how it's trying to make some really complex on-chain strategies feel simple, transparent, and, actually understandable. Okay, let's do this.
You know this quote right here? It really nails the core problem, doesn't it? For so many people, decentralized finance just feels like this big, mysterious black box. Sensei Yield is basically starting from the idea that, hey, it doesn't have to be like that. It's about turning on the lights and seeing what's actually inside. Okay, so this slide just lays it all out. On the left, you've got this alphabet soup of DeFi terms, impermanent loss, yield farming, LPs. It's a completely different language. But on the right, you've got stuff we all get: low risk, medium risk, high risk. This is the language of traditional investing. The whole point is to build a bridge between these two worlds.
So how do you even begin to do that? Well, you build that bridge. The entire philosophy here is to take the concepts you're already familiar with from traditional finance or TradFi and use them as a lens to understand what's happening with these on-chain strategies. Now, this is where it gets really interesting because this is the actual translation guide. So if you're a capital-first or income-focused investor in the traditional world, that maps directly to the white belt in Sensei, which uses really conservative stuff like Aave lending. If you're looking for balanced growth, that's the green belt, which starts to mix in a little bit of market exposure. And for the aggressive folks, well, there's the black belt, which gets into more advanced active strategies.
Okay, so we get the why. It's all about making DeFi risk something you can actually wrap your head around. But what about the how? Let's pop the hood and look at the actual architecture of the system, piece by piece.
And you know what? It's actually a pretty simple three-step flow. First, your assets go into what's called a vault. Super simple. Second, you choose a belt, and that sets your overall risk strategy. And third, these little things called sleeves get to work and actually execute that strategy. That's it. Vault, belt, sleeves.
So what in the world is a sleeve? Just think of it like a single specialized engine that's built to do one thing really well. It's a smart contract that runs a specific on-chain strategy like lending on Aave or being a liquidity provider on Uniswap. Each sleeve is a tool in the toolbox.
And if the sleeves are the individual tools, then the belt is the blueprint. It's basically the master plan that says, okay, we're going to use this much of the Aave lending sleeve and this much of the Uniswap sleeve with very specific limits. This is how the system creates those risk profiles we talked about: low, medium, and high.
All right, let's put this into practice. We'll start at the beginning with the first level, the white belt. This one is designed from the ground up for that capital-first user who's all about conservative strategy.
The white belt isn't trying to do anything crazy. Its portfolio is built on some of the most established, battle-tested strategies in all of DeFi. We're talking about lending out blue-chip assets on huge platforms like Aave and staking liquid staking tokens, or LSTs. These are chosen specifically for their stability and long track record. And that brings us to the bottom line here. The number one goal, the absolute focus of the white belt, is capital preservation. It's all about trying to generate a steadier income stream while keeping your exposure to the wild price swings of the crypto market as limited as possible.
Okay, moving up the risk ladder, we've got the green belt. This is for folks who are looking for a little more growth potential and are okay with taking on some moderate, calculated risk to get there.
So how does the green belt find that sweet spot? Well, it combines those conservative lending strategies from the white belt with some carefully measured exposure to things like ETH or liquidity provider positions. And that word capped is super important. It means the system has strict rules to limit how much exposure it takes on, keeping the profile balanced.
And hey, this isn't just theory. This right here is a real-world example of a live greenbelt vault. That number you see, that's nearly $10 million in what's called total value locked, or TVL. It just shows you that these are active, living strategies that are running right now. And finally, at the top of the pyramid, you have the black belt. Now this is the advanced tier, and it's really built for experienced DeFi users who already get the ins and outs of actively managing liquidity. This is not for beginners. So what's under the hood of the black belt? Its main engine is providing liquidity on Uniswap v3. This is a much more hands-on strategy and involves setting tight price ranges for your liquidity, which can earn you way more fees, but also means you have to actively manage it as the market moves.
So you can see the trade-off pretty clearly, right? The focus here is all about chasing higher fee potential. But that comes with higher risks and more complexity, like the potential for impermanent loss if prices swing out of your chosen range. It's that classic risk-reward dynamic at play.
Look, none of this matters if you can't trust what's happening with your money. And that's where this idea of radical transparency comes in. The whole mantra is trust but verify. And the cool part is you can verify every single thing right on the blockchain yourself.
And this isn't just a promise. Here's how they actually do it. Everything, and I mean everything, is on-chain. The total value locked is public for anyone to see. You can go and check every contract address. You can see the entire history of yield harvests. But the real game changer, the thing that ties it all together, is this last point. There's an AI layer that explains every single action in plain English.
And here is a perfect example of what that looks like in the real world. Instead of seeing some cryptic transaction hash that makes no sense, you get this, a simple sentence that tells you exactly what happened and why. In this case, the system rebalanced a position to grab more fees because the market calmed down. It just completely cracks open the black box.
Okay, so we've covered a lot. The big question now is, how do you use this? Which path, which belt is the right fit for your personal strategy?
Well, it really boils down to this simple decision tree. Is your number one priority steady income and keeping your capital safe? The white belt is probably your go-to. Do you want more balanced growth and you're okay with some bumps in the road? Then you'd look at the green belt. And if you're an experienced pro who really gets liquidity provision, then the black belt is something to consider.
All right, if you take away nothing else from this explainer, I want you to remember these 3 key things. First, this is all non-custodial. It's your keys, your wallet, always. You're in control. Second, the yield isn't coming from some magic source. It's from clear things: lending, staking, and LP fees. And third, the risk isn't a vague guess. It is clearly defined by the belt that you choose to match your own profile.
And we'll end on this thought. By taking a page from the traditional finance playbook, but powering it with the total transparency of the blockchain, how could a model like this actually change the way we all think about and engage with the world of DeFi? Something to think about. Thanks for tuning in.